Hey, what's up? It's Matt, or Investor Dude Matt. I'm here to talk to you about VA loans and creative finance. All right, so some of the things we're going to go over today are what is VA loan entitlement and why that matters to you. We're going to go through what a VA loan assumption is and some of my opinions on whether or not you should be using that as a strategy. And then we're going to go through a VA loan entitlement calculator that I put together for you guys and how to use it. And then finally, we'll talk about some of the ways that you can help a seller out and what are some of the methods you can use with creative finance. Some of the things that I believe qualify me to talk about this topic. I'm a veteran. I've been in the Oregon Army National Guard for 10 years. I bought my first house with a VA loan. I've refinanced that to a conventional loan. I tried to work with another veteran to take over their loan through an assumption. I have not done a deal where, or had the opportunity to take over a VA loan with subject to or some form of creative finance, but I have self-performed an FHA hybrid deal. So a lot of that would be pretty similar. The VA loan was created to help veterans get primary residences despite having maybe less than stellar credit, the option to do zero down. Essentially, what the VA does is they guarantee 25% of whatever the loan amount is. And that guarantee is quantified into something called entitlement. Now, this entitlement is super important because this is what is going to dictate how much house they can buy once they've purchased a house with a VA loan already. So there's actually two layers to entitlement. There's the basic entitlement, which equates to $36,000. And then there is the second tier entitlement. And the reason why there's two tiers is, again, remember they guarantee 25% of the loan. So with that 36,000, if you were to times it by 4, then you get $144,000. Now, I'd be very surprised to see how many homes you can buy these days with $144,000, and the VA knew that as well, which is why they created that second tier entitlement. That entitlement changes for every county in the United States, and they publish this forming loan limit for every county. As of January of 2021, if a veteran has their full entitlement, there's no limit to the purchase price of a house they can get and get zero down. Now, where most of us are going to come in with subto creative finance is when they're looking to offload that first house and get another house after you've taken it over in some creative way. That's where this second tier entitlement and the county loan limit really starts to take effect. To take all the guesswork out of how much house they could buy with that remaining entitlement, I've built a remaining entitlement calculator, and then I'll just put that on the screen now. All right, so let's talk about this VA loan reduce entitlement calculator. So the purpose of this calculator is to determine if a seller has purchased a home with a VA loan, how much house can they buy with their remaining entitlement? Now, this can determine how much they can get with zero down, but also if they were to go above and beyond their reduced entitlement, how much would they need to put down as a down payment? So let's use a real life example for me and where I'm currently sitting with my reduced entitlement. So I bought my first house with a VA loan, zero down in Salem, Oregon. I did not do any sort of a down payment. So if your seller for some reason put a down payment, you would put it here in line 2. And now you can see this is how much entitlement I used. Now, the 68,000 is 25% of the purchase price. And so this number is significant because, again, remember the VA guarantees 25% of the loan. So now, if I was going to go and get a second VA loan, the two pieces of information you need to know first and foremost are the state that I would intend to buy. And let's just say I'm going to stick to Oregon. And what county would I want to buy in? Let's just go ahead and say Polk County. So now the calculator is going to automatically pull the most recent VA county loan limit. And then Line 7 is going to calculate 25% of that county's loan limit. Now, line 8 is going to subtract how much entitlement I use for my first VA loan from the maximum amount I would qualify for in this current county here. So now my reduced entitlement is now at 93,000. And if I wanted to buy another home with a zero down VA loan, I'm looking at 375,000 essentially. Now, if I wanted to go above and beyond that, which here in Oregon, we're more than likely going to do that. Let's just say I want to buy a house for 500,000. If you go above and beyond this number in line 9, then the VA says the difference between these two numbers times 25% is what your down payment would need to be. And so in this instance, my down payment is 31,000, which is only 6.3% of the purchase price. Now, what would be dope as someone in creative finance trying to close a seller is if, for example, I'm the seller, right? And I'm going to buy this $500,000 house, and all I care about is putting zero down because that's what I want to do as a veteran and use my VA loan. What if you came in and said, hey, how about let me take over your first house with creative finance and I'll pay the $31,000 down payment on your next house? And so it's beautiful for the veteran because they're going to put zero down. They're not going to have to pay PMI. And their rate is probably going to be lower than a lot of other loan products out there. So a win for the creative finance closer and a win for the veteran that you're trying to help out. How can you fully restore a veteran's entitlement? There are 3 ways that it can be done. The first one's just a flat out traditional sale. The second is that their loan is assumed by another veteran doing something called a substitution of entitlement, where the veteran who is the buyer has enough entitlement on their certificate of eligibility to fully restore the seller's entitlement. And then last, if a veteran pays off their VA loan, however, keeps the house, so essentially a refinance, and then they do something called a one-time restoration of entitlement. Then for one more purchase, the VA is going to allow them to use their full entitlement to purchase another house. Let's talk about VA loan assumptions, in my opinion, on if they're a good route to go. Number 1, just as an investor, but number 2, if you're trying to restore a seller's entitlement. Number 1, is it a good route if you're trying to acquire rental properties? In my opinion, I don't think it's the best route to go for a couple reasons. Reason number 1 is Pace's big thing with creative finance is that you can get homes without using your credit, your credentials, those things you need if you're going to go forward with an assumption, because the bank is going to want you to qualify for all the same things that the seller did. And then secondly, they're going to want you as a natural person to be on all the documentation, to include the deed and the debt. They're not going to allow you to do it with an LLC, a trust, any other kind of an entity when you're going forward with that assumption. Is it a viable option for restoring a seller's entitlement? Again, the only way that you're going to restore that entitlement through an assumption is if you're a veteran with enough entitlement on your certificate of eligibility. If you're just a regular person trying to take over that loan through an assumption, all that entitlement is still locked up in the property. There's nothing you can do at that point to change it. I say that it is the one way that you might be able to get a creative deal done, but it might be a long shot because would need to refi their house. And then at that point, you would probably take it over subto or with an executory type contract. And then the seller would need to do the one-time restoration, and then they could go forward and find that next house. Who knows if when they refi, it's still gonna cash flow for you. Who knows how long that process is gonna take, but it is a possibility. Ways that you can do creative finance with a VA loan. From what I've heard from Pace's videos, if you look up the video with Eileen Brown, where they're talking with her at the title company, she talks about mirror wraps, which are essentially an executory contract where your terms mirror the seller's current note on their mortgage, and you're just taking it over with, like I said, the executory contract. Now, in some states, that's called an agreement for sale. Here in Oregon, that's called a land sale contract. Up in Washington, it's called a real estate contract. Some places, it's a land installment contract. You get it. Essentially, what that does, and it's different than subject to, is that the deed stays in the seller's name, and you have this contract that once you satisfy all the terms in it, then you're allowed to get the deed to the property. Now, I'm also starting to hear there's folks that are taking over properties just straight up subject to with the VA. But again, I haven't had the opportunity to take a property over subject to. That's a VA loan. So take that for what it's worth. All right, so now you should understand entitlement. You should understand how you can restore a veteran's entitlement. And you should have a little bit of an idea of how creative finance can be used to take over some of those loans. So, hey, if you got any questions for me, you can reach out to me in subto. Follow me on Investor Dude Matt. And now that I got a YouTube, subscribe to the YouTube.